later. I'm Owen Rask and welcome to Selfwealth Live. We've got a very special show tonight because we're joined by Luke Laretive, co-founder of Seneca Financial Solutions, and we're talking about a few topics that I don't know that much about. So we've got an expert on, and this is by popular request. So I know Luke's going to bring some ideas, some companies. He's got a heap of data. Luke's really data driven, which is, just I have so much respect for investors that are data driven and can really get stuck into things from a factual basis and then insert some qualitative research over the top of that. I think that's the way to go. So we'll have him with us for 20 or 30 minutes tonight, and then we'll just have a bit of an open mic kind of Q&A with me towards the back end. But I do have a little bit of a slide presentation that I put together before we welcome Luke onto the show. And so the first thing, obviously, is the official joke. So my wife says I'm getting fat, but in my defense, I've had a lot on my plate lately or recently. So that's my joke for tonight. It's a bit self-deprecating, but I'm sure you'll be okay with it. Don't forget, Rob is behind the sobriquet or the pseudonym Selfwealth on the chat there. He's given me a 5 out of 10. So Rob, I can see you. You've given me a 5 out of 10. Not sure about that, mate. Maybe I'll follow up with you after hours, but I think it's pretty good. It's probably on brand for me too, to be honest, because I have been in a pretty good paddock lately. That's why I wear black a lot of the time. Anyway, so I recently did something interesting. For my 21st birthday, I actually got a newspaper that was published on the day of my birth, which, as you can see on the screen in front of you, is a little while ago. And I know what you're thinking, like 1990, how does he look so old when he's only 32? So, work in finance, I think that's one of the things to say. But I've got this old newspaper here, and I thought I'd flick through it. And after having it for about 11 years, I thought I'd finally open the darn thing. And what I came across was a lot of stuff that seems similar to the things that we talk about today, just in a different way. So here we've got Citibank offering some sort of cash management account for 15% per annum. You take that. There's another fellow on this side. This is an article by Louise Harris that says diversification is the key. Looks like a guy doing the old pistol with the fingers there, which remains relevant today. The next one is a bit of fun. I'd be amazed if I could computerize my business for, and then there's a bit of marketing here. I don't know what business this is, but it's a bit of fun. It's a bit of fun. Here on the next one, we've got oil price fall fuels 68-point Dow leap. So the same headlines that we would get today. Oil prices doing something. Headline writer says that affect the market somehow. And then also on the other side, we've got the cliche marketing that tends to come. Don't gamble with your financial future. Roll over to IOOF. And this is kind of a play on everyone's belief that somehow the stock market is like gambling, even though you might think that. It isn't always the case. And finally, the best one of all, which is something that I had to flick through to the business section to find, which is there's this headline from AMP there. There's 2-page spread, and it said AMP will always be there for our policyholders. Here's why. And it then goes on to say that they own so much of different companies. And if we zoom in here a bit, I'll bring this up. AMP says they own over $1 billion of BHP and a bunch of other companies, which BHP and Rio Tinto ended up combining or buying out. Now, Pacific Dunlop there, which one of the textile businesses, no longer with us, Brambles, Boral, National Australia Bank. Interestingly, this is the AMP share price over the history of its listing. So it's been around for a very long time. It may have been there for policyholders, but I'm not sure if it was there for shareholders. I think that's kind of my takeaway. So some things maybe are staying the same. But anyway, a quick disclaimer for tonight. My name's Owen Rask, and any of the information that you hear from me this evening is limited to general financial advice. I'm not giving you personal advice, even if I do answer questions in the live chat. Same goes for Luke. Luke is here and he's giving general financial information or general financial advice. Neither one of us are going to give personalized financial advice because we simply don't know your financial circumstances. Be sure to refer to the financial services guide that the Rask Group has, or that of Seneca Financial Solutions, before acting on the information. And finally, if we do say things tonight, please remember that it is our information and it's our opinion only, and it does not necessarily represent or reflect the views of Selfwealth. So Eve, you've said, also, we now know Owen's birthday, so that's Rob saying that. And Eve says, AMP are the only shares my mother owns. has owned them since the 1990s. Not done so well, lol. Yeah, well, we all have those. Interestingly, I didn't see CBA in that list there. So we all have those. So that's okay, Eve. AMP has been a basket case. This newspaper is actually hilarious, says Rob. Well, Rob, yes, it is indeed. Okay, so tonight on Selfwealth Live, I would like to welcome Luke Laretive. As you can see in Luke's bio, he has a decade of experience providing strategic investment analysis and advice to some of the world's leading organizations. Luke has joined me on a few Australian Investors podcast episodes, and in those episodes, he talks about his background, not only like in the numbers and accounting, but also in like the mining and resources sector. So that's why I knew that he would be the perfect guest for tonight. So, Luke, welcome to Selfwealth Live, mate.
Owen, thanks for having me, mate.
Yeah, mate, it's my absolute pleasure. Thanks for taking time out. I can tell you're in the studio there. You got the Seneca logo behind you. Mate, I asked you in anticipation for tonight because the community asked me which gold stocks, which lithium companies can we talk about, which ones are really interesting. I remember Mike last week wanted to talk about, I think it was Evolution Mining, which is a business I don't really know that much about. But there are heaps of these companies on the other side of the ASX that I frankly don't know that much about. So I'm hoping we can dive into that and also get some questions across to you.
Sure.
First of all, mate, can you explain, I guess, do you invest in gold? And then maybe on the back of that, if not, why not? And we'll just go from there.
Yeah, sure. So do we invest in gold? Have we invested in gold? Yep, we have. Are we currently investing in gold? No. So we kind of use gold tactically, and I think it's the only way to use gold.
Mm-hmm.
I think investing in gold is not just something you should always have in your portfolio, and we can kind of get into some of the specifics around it. And it's not actually a great investment for the long term, historically. So definitely something that needs to be used tactically, and which can be difficult to do. But yeah, that's kind of our use case for it, I suppose.
So I know that one of the things that we wanted to talk about tonight was the difference between gold mining companies and investing in gold itself. Like there's Warren Buffett's famous line that people who invested in gold many decades ago, they invested in 1 ounce of gold. They still have 1 ounce of gold, but people that invested in a company may have dividends or it may have grown since then. Can you maybe just wrap some numbers? I think you've given me some charts which I can share with the audience tonight, but can you kind of like wrap some of those numbers around your belief and how you form that opinion of gold being more of a tactical bet?
Yeah, sure. So I think first and foremost, need to understand like what you're going to get when you buy a gold miner versus buying the gold price, and the gold price and the gold miners move together. Thanks for that. Yeah, like so, as you can see here, this is 10 years, and they pretty much step for step on a week to week basis. So that's kind of where. From my perspective, if you're going to make a bet on gold or a bet on gold stocks, you need to know where the gold price is going. But the gold price, is more of a macro thing than anything else, and it really does follow, inflation expectations. And the best way for us to kind of use a proxy for inflation expectations is to have a look at the US inflation adjusted bonds, or the TIPS. And that's not the chart, Owen. That is.
Right, I'll get that up. I'll get that up for you.
Yeah, is so, essentially, that is the correlation, I suppose, over the last 15 years with inflation expectations, for lack of a better word, and they've diverged recently, and I've written it there. Why they've diverged is due to interest rates changing, and it's devalued the value of those bonds, and the yield's gone up on them. But you're still getting a good idea of, I suppose, direction and potentially, what might happen to gold prices and subsequently gold stocks kind of next. So, I think when we're talking about investing in, stocks versus gold, physical gold, you're going to get a lot more volatility with stocks. You get a lot more stock-specific issues, and certainly, you're going to also have that operating leverage if the gold price is high, and you've got a high-cost producer that they might, suddenly go from being cash flow negative to cash flow positive, which could be a significant, I suppose, catalyst for share price re-rate. Whereas in the gold price, you're kind of going to get a smoother ride. But both historically have been pretty poor investments. And I'll maybe just pull up that asset class comparison chart.
There we go.
Yeah. So that's not tips and gold price. That's That's the currency. I'm going next one. Yeah. So you can see here that pink line is the MSCI All World Index. The blue line is the ASX 300. The purple line is the Bloomberg Global Aggregate for bonds and corporate bonds, investment grade corporate bonds. And the gold dotted line is the gold price, and the gold solid line is gold stocks, or the Van Eck Gold ETF. So you see, like over a 10-year period, you're much better off owning, the market, or even up until very recently in the bond sell-off, even just holding a very low volatility bond, diversified portfolio of bonds, than you are, investing in gold. So, why would anyone want to invest in gold? And there's a really good reason, and that's to do with correlation. And gold's actually negatively correlated with stock prices to the tune of 35%, so negative 0.35. And that's a really significant thing. There's very few places in the world and few things that you can invest in that are negatively correlated with equity markets. And as a result, that's what makes gold, useful in a portfolio. But as I said, if you hold it long term, all it's going to do is drag down your returns of the rest of your portfolio. So it's all about finding those periods when you think gold might outperform or gold stocks might do well. And that's generally when inflation is high and rising, as a general comment.
So can I just recap on something there? You said that it's generally when inflation is high and rising, right?
Mm-hmm.
Can you just go back and just explain this one for me? Because I think I missed that. Why is there a divergence between inflation-adjusted bonds and gold?
Okay, so bond that bond chart's a little bit tricky to sort of get your head around. So that's essentially the yield on bonds inverted. So the easiest way to think about it is the price of the bond, but obviously as price goes up, yield goes down, and vice versa on a bond. When interest rates change, the value of all bonds, changes. So that's why you've seen this sort of cliff, I suppose, or yield go up on these bonds. If you're looking at the right hand side there, the yields moved from 1.5% to 3.76% now. And that's what's caused this divergence, I suppose. It doesn't necessarily mean that the relationship's broken or that this doesn't work, longer term, but it just means that just right now in this particularly volatile interest rate environment, both here and obviously in the US, and the speed at which those rates have changed, we've just seen a significant dislocation in the short term.
Okay. I think this one here is the S&P 500, isn't it? So this is the S&P 500 versus gold price, if I'm not mistaken. So there was a question that come through from Harris that definitely would be interesting in knowing why Luke doesn't see gold as something to hold long term. And I guess this is encapsulating this, right? So reflecting on what you said before, the gold price just simply doesn't keep pace with risk on assets.
Yeah, and I mean, you don't want to. I mean, if I could have a portfolio of 50% S&P 500 since 1988, it's as far back as my FactSet terminal will let me go, and so if you had a 50-50 portfolio here, you're going to end up at like 1,500 or 2,000 on the right hand side there. Whereas so you're trying to generate the best returns. That's obviously just hold stocks, hold equities. Whereas, if you're trying to generate more stable returns or, do something else, there's probably better ways to achieve that aren't just investing in gold or a portfolio of 100% gold or putting that drag, next to your equities portfolio. So, not saying there isn't periods in here where you want to own gold, and not saying that you can't add something to your portfolio, but, it's generally in, high inflation environments as a general comment.
Yeah. Okay. So this makes so much sense to me from a tactical perspective than with gold,
Mm-hmm.
I know because you're qualified to give advice and do all these things as well as, creating investment portfolios for clients at Seneca and what have you. What do you typically see when someone does use gold as a tactical bet? What do they typically allocate to it as a percentage of their portfolio? Like, what would be normal in your opinion?
So I suppose in our Seneca Australian Shares SMA, we've had up until pretty recently a decent allocation to gold. It was 6 point something percent.
Okay.
So we held Northern Star for a long time. We've been a shareholder there, and that's been a recent exit for us. And we also lost some money on West African Resources inside the 200. So we've held gold stocks along the way. We've held SLR at different times as well. So it's not we think there is appropriate periods, and there has been certainly a really good period for gold in recent history. Whether that continues at the same sort of rate, look, I don't know. But at the moment, we don't hold any gold stocks. I think the inflation expectations are coming down. So that's kind of why.
Yeah, fair enough. So there was a question that come through just basically talking about the currency impact. And I think, Eve, your question talks about this too from Cameron. Is there a difference between Australian gold miners and international gold miners or gold, considering hedging and whatnot?
Okay, so when we talk about gold here in Australia, it's really relevant to talk about the currency. So obviously the gold price is denominated in US dollars. So that's in the light blue line there. That's the US dollar per ounce gold price. The purple line's actually the AUD return. So, and the pink line's the AUD USD exchange rate. So, that's over the past year, just to demonstrate, over a period of time. So if you were hedged in gold and trying to take as lowest risk as possible, you'd have a 2.something% return. If you were unhedged, you're at 14%. So the gold price and investing in golds, it can be, physical gold can be a bit of a currency warrant for us here in Australia if you're bringing everything back to AUD. But certainly for the companies, a depreciating AUD against the US dollar can be a really big tailwind for their earnings and their free cash flow. So if you're looking at ASX listed gold miners, they're going to be selling in US dollars and converting. A lot of them do hedge that, and they also do hedge the gold price as well. So you need to be aware of kind of where they're positioned relative to what your expectations for earnings are going to be in the forward period. But certainly currencies are a really important part of investing in gold for Aussies.
No, yeah, that's kind of the question we often get. Like the chart pack that you've sent through here is talking about like the Van Eck Gold Miners, which is the kind of the equities side of like the gold mining companies themselves.
It's global as well. It's not just Aussie listed.
Exactly, yeah. But a lot of people here in Australia really just compare between two major ETFs for pure gold, which is GOLD from Global X and the QAU from BetaShares, the unhedged and hedged version of those. Okay, so this last chart here, so that's the lithium chart. So there was, I guess, a couple of other things that I wanted to touch on with you before we move on to lithium, actually. And I see a couple of questions that have come through on this. Is if you were tempted to invest in gold, which companies would be, which would take your fancy, and how and why would you use them?
Okay, so if you're going to invest in gold, it's all about stock specifics. So just because I'm not bullish on gold from a macro perspective doesn't mean that I wouldn't invest in a stock, in a gold mining stock for a stock specific reason. Okay. Generally, though, given that we're not sort of structurally bullish on gold, which there's lots of opinions out there, and I'm not the arbiter of truth. We'll soon find out whether I'm right or wrong. There are still interesting companies, particularly sort of in the small and mid cap space, where you've got M&A targets, you've got guys adding to their resource and growing their asset base, and also those sort of improving their operations in one way or another, turning things around, new operators, new management. So I think from my perspective, that there are still some interesting companies. The first one I thought we'd talk about today is Aurelia Minerals. Code for that's AMI. And they've got a new management team. They've got 3 operating sort of base metals and precious metals assets, New South Wales based, good cash flow, reducing their debt, and they're cheap. They're really, really cheap. So a little bit high cost, and not super high quality assets, relative to some other companies. But if the gold price is going to be higher, these guys are going to be a real sort of beneficiary. We can kind of get to 160 million bucks in free cash flow for this business, and it's market capped at 100 mil EV. So we think there's potentially some upside here, a little bit of risk, certainly, and it's super sensitive to commodity prices, but from my perspective, that one kind of screens pretty well and looks okay.
Look, can I just ask you?
Yeah, man.
How important is, so when you say like that's a lot of free cash flow for a business this size, right? That's a
Yeah.
huge. How do you think about like when you put in like what you expect the gold price to be? Do you have like a sensitivity around that? Do you have like a base rate? How do you figure that?
But we tend to, for short term stuff, we'll just look at spot, right? Like how could this thing go if gold prices just stay the same?
Okay.
I think it's important to have a look at I suppose like the sensitivity. Like I said, like this thing can go from positive free cash flow to negative free cash flow on a pretty small move in the gold price. So that's kind of why I'm putting an asterisk on it and saying it's a little bit high
Yeah.
risk. But that being said, it is new management. They are making a concerted effort to improve. So hence why we don't mind it. Like I said, I don't own it. It's on my watch list. It's something as a stock we're following.
Mm.
And if we did sort of think the gold price was going to move higher for some reason, I reckon that'd be a reasonable way to have a crack at it.
Yeah, I think that's a really good asterisk that you insert there around risk. Like obviously, small-ish gold mining company. For anyone that's watching, what Luke is basically saying is that it depends on the gold price whether this thing shoots higher or lower, and that's that volatility that he talked to at the beginning of the show, where if it's the gold price stays high, you might get some outperformance, but if it goes down, you may go down a long way. So it's a really important reminder there, Luke. Thanks for that, man. And this is business I said to you off air that I never heard of, so I'm glad you could bring this to the show tonight. You got one more for us, one more gold mining business before we move on to lithium, I believe.
Yeah, like maybe like a little bit less specky. Again, high cost. Again, it's on the basis that if you think the gold price is moving higher, like you want to buy things with the most leverage. You want to make the most. If you're going to make a macro bet, I think in markets more broadly, I think you want to get paid for taking that kind of risk because it's really hard to do repeatedly and consistently.
Yeah.
So if you're going to get something right and you've got a real high conviction view on something, you want to get paid. So West Gold Resources, WGX is the code there, Owen, and it's got a few mines in WA, essentially underground mines primarily. But they've got an asset in Big Bell that could be potentially a bit of a value driver for the business. They've given some guidance, which is sort of cut back from where they were. Stocks sort of pulled back on that guidance and bounced a fraction. But we think they've got good cash balance, 150 odd million bucks, and they've got a bunch of sort of fleet there that's probably worth, I don't know, 150 million conservatively. So when we start to look at the EV for this business at 380 mil, generating pretty cheap market cap or EV relative to their production base. So you look at companies like SLR, they're doing 170, 185,000 ounces. And their market cap or EV of 825 mil. Well, Westgold's doing 240 to 260 at 380 mil. So, some significant kind of valuation dispersion there. Again, there's no free lunch in markets. There's reasons for these things, but we do think that perhaps Westgold's got some upside. When you start comparing it to the Silver Lakes and the Gold Roads of the world.
Yeah. Okay, that's great. It's a little bit bigger of a business. Yeah, that's great. And I also like your idea of thinking of it in terms of, if you are going to take a position, you take the position that, from a portfolio perspective, maximizes your return for that given level of like allocation. So, for example, if you had a view on gold and there was a comment like this in the chat, you could put 4% of your portfolio, 5% of your portfolio in a pure gold. But if you had such a strong view, the return for putting 5% in something that's a productive asset, which benefits from higher gold prices, is probably more profound, if that makes sense.
Look, it depends what you're trying to achieve, right? At the end of the day, I'm getting paid to make people money and make as much money as possible. So at the end of the day, I'm going to look for those opportunities where I can get asymmetric payoff for getting something right, and that's the job, right? Whereas maybe if you're not trying to optimize returns to the level that I am all the time, you're more than happy just to make 5% on the gold price move that you get right. But from my perspective, that's kind of, you're going to get torched at some point, trading commodities like that. And I think you want to be making as much money as humanly possible while you're right, because, you flip the coin enough times, you're going to be wrong.
Yeah, absolutely. No, I think this was a great foray and some good ideas for folks to pop on their watch list, mate. But a few weeks ago, um, or it's probably actually a few months ago now, you and I spoke about lithium companies for the Australian Investors Podcast. The first time I'd ever covered lithium, and all throughout 2022 here on Selfwealth Live, we every week, companies like Pilbara, Core Lithium, all of these businesses were constantly at the top of the most traded shares. And I really couldn't add that much value, mate, until I spoke to you and I got some sense of how it all comes together. But for folks that haven't seen that discussion, can you maybe educate us a bit on the lithium market overall and how people can think about different mining types or how the industry forms, if that makes sense?
Yeah, I think so. So, like, from a, I suppose, listed company perspective, you're going to kind of hear about three sort of products, for lack of a better word. There's spodumene, which is just like the rocks. They get processed up, crushed, and floated and treated with acid and turned into sort of two main products in the lithium market, both using batteries for different things, but lithium hydroxide and lithium carbonate. So they're sort of the three things you'll hear people talk about. Most companies and listed companies and resource, for that matter, gets defined as sort of lithium carbonate equivalent. But they all have slightly different pricing dynamics, and it's kind of similar to my old gig in coke and coal. So you have it's all condensed carbon, but at the end of the day, there's hard coke and coal products, premium low vol, PCI, semi soft, like it's all different. So and it's got different uses. Maybe lithium it's not so different, but you kind of get my gist. There's different products. A general rule of thumb, spodumene is like 1/10 of the price of sort of hydroxide and carbonate, and all those prices have kind of come off. So talking sort of the hydroxide benchmarks, they've come off from sort of over 80,000 a tonne to kind of under 60,000 a tonne now. But bearing in mind that they were 10,000 and lower not that long ago. So that's kind of been, I suppose, the market over the last little while. And like this is sourced from Bell Potter that I just pinched off one of their reports. So apologies, Bells, but so you can kind of see here the prices across spodumene, carbonate, and hydroxide all rolling over, and also the ratio of the premium, I suppose, of carbonate and a hydroxide, and that's coming down as well. Look, this is a pretty probably too detailed for what you guys want to chat about today, but it's just good to understand what people are talking about when you hear these things in the market, I suppose. But lithium stocks have pretty much followed suit, and sounds like everyone here is pretty interested in the Pilbaras and the Allchems of the world. So you probably have seen the share prices come down pretty dramatically on the back of these moves. But like someone's just commented, then Mike's just said, Pilbara does pay a dividend on Friday. And I think the cash flow that's coming out of these businesses, even at, the current prices, is insane. Like, it's absolutely nuts. So I think if, we can get into whatever you want to talk about, Owen, to be honest. But the main sort of reason and some of the negativity that's come out at the moment, there's been a couple of analysts, one from UBS I saw and one from Citi, come out recently and sort of talk about supply-demand balance and say that there's going to be a bunch of Chinese supply coming onto the market. Look, our view here is that car companies aren't going to be trying to clean up their entire supply chain, change from internal combustion engines to EVs, do all this amazing stuff for the planet and for people and ethically sourced everything, and then all of a sudden just go to China and buy Chinese lithium. So I'm not too concerned about incremental additional Chinese supply. I still think whether it's the Raw Materials Act in Europe or the Inflation Reduction Act in America, I think if you read what the governments are putting out and what the regulators are putting out, they're all looking to bring stuff sort of back home, produce locally, use as much local product as possible, and certainly not be sourcing whether it's cobalt, lithium, any of these sort of strategic minerals from ethically dubious locations.
Yeah, that's a good point. I think when you see lithium, you see it like it's like in Chile where it has like the big ponds.
Yep.
Can you explain the different or what that is? And I think it was Vulcan that you mentioned maybe does a different type of mining, if I'm not mistaken.
Yeah. Okay. So, there's sort of two types of, I suppose, lithium extraction. Like I said, you can mine spodumene, the hard rock. It's quite a good-looking kind of rock if you type it into Google, and put that through a process, and it becomes battery-grade lithium. And or you can have a brine. It's like a hot, salty. Yeah, there you go. A hot, salty liquid from deep beneath the earth, and you can pump that to the surface, and yeah, it kind of looks like that. And what happens is comes up with obviously a lot of water. All that water gets evaporated off in these ponds. They sit in these ponds. The sun just literally just takes the water out of it and leaves it with the lithium essentially. So these sort of two conventional methods for getting battery grade lithium. There's this new sort of, I suppose, method, or relatively new last 10 years, called direct lithium extraction, which takes those brines, and rather than using the sun to take away everything you don't want, it uses an electrolysis process. It's pretty similar to like what the chloralkali industry use. So yeah, that's sort of now being used by like the Berkshire Hathaway project in the Salton Sea in California, Standard Lithium. A couple. There's probably 3 or 4 in China as well. There's 2 that use the DLE technology, and on the ASX, there's a number of companies purporting to want to use DLE. The most sort of advanced and technically well supported is Vulcan, codes VUL. If you've watched any of my stuff or listened to me or read me, we've been a shareholder in Vulcan for a long time. We really like the business, really like the management, and think it's significantly undervalued at the current share price. Happy to, if anyone wants to chat about that or hit me up, happy to, talk about Vulcan until the cows come home. But yeah, that's sort of that business is essentially combining a DLE brine lithium extraction sort of project with a geothermal project, which is going to power the project. So they're going to be able to produce net positive, actually, but say zero carbon lithium is their product. And the reason why we like that so much is we think that product's going to be able to attract a premium. And we think at current prices that, the execution risk is there, no doubt about it, but it's just massively mispriced by the market. And the cost of capital that the market's assuming is overstated. So, that's kind of our sort of core thesis there, and continue to be sort of, long-term holders.
So out of all these lithium businesses, is that your pick of the bunch then?
Look, for me, from the developers, certainly. I think outside of that, there's other good businesses too. Like Liontown's a really good business, and developing a good project. We think that's got strategic value. I think it's similar to the gold. Like if you're going to get into these mid-cap companies, you kind of want those with good projects, large scale, potentially low cost, ideally near bigger companies, so they can get bought out and get those synergy benefits. So Liontown's close to stuff. Galan in Argentina is close to stuff and got a really big high grade asset. And we think Piedmont as well. They're sort of strategically located. So it's not just Vulcan. There's other things too. We just think probably that Vulcan's, in terms of potential upside, it's that's certainly got the most leverage.
How about Allchem or SYA, which is Sayona Mining?
Yeah.
Have you looked at those businesses?
Look, I think the best way to play SYA production is Piedmont. So Piedmont have got a deal with SYA where they've got a capped price of $900 a ton, and so to buy spodumene, they're selling for $6,000 a ton. So they're just going to make that difference and flick off every 50% of the production off. So I think without a doubt, in terms of bang for buck and market cap and that kind of thing, PLL is a way better way to play production at that particular North American lithium project. Allchem, look, it's really, when you start talking about like Allchem, MinRes, Pilbara, it really does come down to, I suppose, valuation and your views on kind of that. Like, I've read plenty of things that think that, Allcam's the cheapest and best stock in the market at the moment. I've read plenty that, plenty of people prefer Pilbara for a few reasons. Like, we own Pilbara at the moment. We don't own Allcam. So I think obviously, like, we prefer Pilbara, and the reasons, really to do with strategy and execution and also asset quality as well as valuation. So we think Pilbara's got a bit better leverage, and a bit better, and sort of operate in a tier 1 jurisdiction.
Mm-hmm.
So that's for us. We also own MinRes. We think their lithium assets in the current guise are significantly undervalued by the market. And we think a spun vehicle there, which I know that they've said they're not going to do, but they'd be mad not to at some point, is worth more than the current business, when it's got essentially a mining services business and a really high cost iron ore business attached to it. It's kind of dead weighting it down. So that's kind of our view on the producing assets.
Mm-hmm.
There's also some good producing assets overseas and good businesses around the world as well. So encourage people to have a look at what's happening overseas as well, because there are some good businesses.
Absolutely. Conscious of time, mate. For anyone that is watching and you want to hear more from Luke, there's actually a link in the video description for this episode where you can get a free report on 3 dividend stocks from Luke. And in doing so, you'll join the Seneca mailing list, which is all free. You'll find that just in the description of the video. But mate, before we let you go, maybe just can you just explain maybe your background and what you do at Seneca today? Tell us a little bit about yourself, because we just dived straight into it. I realized we didn't really get straight into what you do in your background.
I don't know if I'm interested on, but
and why you were placed well to give us this chat tonight.
Okay, so I started. John and I started Seneca 5 years ago. We're a high net worth advice boutique. Across sort of, like I said, funds management, stockbroking, and sort of strategic advice. Before that, I worked at a stockbroking firm for a few years, and kind of built a business there. And before that, I worked for Vale, which is the world's largest iron ore miner, and I sold metallurgical and thermal coal for them. So worked on supply demand models, figured out pricing strategies, and sold to your POSCOs, Tatas, Nippon Steel type customers in the steel division. So that was my sort of second job, and before that I worked for Deutsche Bank in London. So that's kind of been my little background, and really happy running a small business now here in Melbourne.
Yeah, great. We've spoken about this before, Luke and I, so if you are interested, you can just search for Luke's name online and I'm sure things will come up. He also is a regular on channels like AusBiz and Around the Traps. Mate, maybe I've got 2 more questions if I might just really quickly squeeze them in, because I know you need to get to dinner. Paul just asked, Tackle Safari just asked, so is lithium a long-term hold, and do you think demand will continue?
Yeah, from my perspective, I think if you look at the sort of supply demand forecast, equilibrium price, incentive price, all that kind of good stuff. One thing I learned modeling coal mines and coal prices was that whatever supply you think's coming on, whatever you can go on ASX announcements and find and build your model around the world and what all the companies say they're going to do, never ends up being that big. It never ends up coming to fruition. And even the highly probable stuff sometimes isn't as big or as quick or as cheap as everybody thinks it's going to be. So it's really hard to get a mining project up for a number of reasons. That's why you can make a lot of money if you can go from a discovery through to a full-fledged, cash flow positive project. So I think, first off, supply assumptions are conservative and overstated. I think also demand is underappreciated. And I'll credit Tim Hoff from Canaccord Genuity, wrote an excellent piece on the idea that the more lithium supply that we create, the more that electric vehicle companies will drive, to electric and increase the production of these cars and make them cheaper and more accessible and da 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 da. So I think there's a scenario here where supply actually drives demand, and that's actually a really I think it's really smart. It makes a lot of sense to me. And I certainly didn't think of it. But yeah, if you've got access to Canaccord research, I'd suggest seeking that out from a few months, or maybe even 6 months ago now. But yeah, it was a really good note. So yeah, look, I'm really bullish on lithium prices. I think that a lot of people don't understand it. I think there's a lot of opportunity in the developers. I mean, yeah, sure, I love Vulcan, and I think Francis and the team are fantastic. But the developers in general are all trading at percentages of NAV. So if they get through the execution risk, they get through financing these projects, it's going to be a significant uplift, and some of them have optionality well beyond what their PFS and DFS is kind of pointing to at the moment in terms of an MPV for the project. So, no, I think I'll be a lithium investor for a number of years to come, and all the best forecasters, the Wood Mackenzie's, Fast Markets, Benchmark Minerals, all have markets in huge deficits till 2035, which is as good as far as you can forecast. So I'm definitely a lithium bull for sure.
Okay, great. And one final question, and just so we know, like, you can get in contact with Luke. As I said, there a free report which will put you on his newsletter, but you can also visit the Seneca website if you want to ask him questions. He's the type of guy that will talk stocks to you all day and all night. So
depends how many people hit me up. Oh, and don't be saying that.
Not too late at night. Yeah.
Don't ring my mobile. Don't ring my mobile. I'm not.
But I got one more question, just and as quick as you want to just weigh an opinion on this, just from Paul, which is how about battery making stocks? So just as well as the lithium itself, but kind of like the further in the value chain, if that makes sense.
Yeah, there's some private businesses, battery businesses here in Australia that are kind of interesting and have done really well in sort of raising money privately. I was talking to an investor today, natural resources specialist, talking about a battery company that is 50% uplift on their latest round for capital. They're probably going to IPO next year. But like I said, I think that the returns are disparate, and it depends on the project. It's not something that I'm super interested in. I think I'm kind of focused really on the raw material space from an investment perspective. But certainly, I think there are battery projects that have got some attractive returns. I do think, though, that we're going to need to find some baseload power from something that's not batteries for a while just yet, and whether that's gas or whether that's uranium or something like that, then I think that's kind of where baseload power is going to have to go first before we've got these sort of huge networks of batteries.
Yeah, great. I like it, mate. Well, thanks. Hey, thanks for taking some time out to join us tonight. I hope we didn't make you too late to dinner. And if you want to get in contact with Luke, please head to Seneca's website, Seneca Financial Solutions. Like I said, there's a link, so check that out, mate. Pleasure. Thanks for joining us.
Cool. Thanks, guys. Really appreciate having me.
So that was Luke Laretive from Seneca Financial Solutions, based out of Melbourne. We actually share an office sometimes when he's in, sometimes when I'm in, which is quite rare actually these days. But it's always a great chat speaking with Luke. So thanks once again to him for taking some time out on his Wednesday night. Now, one of the things that, in addition to lithium and all these types of things that I know you wanted to talk about, I'm glad we could have an expert on the show to deal with that. And for Luke to come on and kind of nail that for us. So, but the other thing that everyone wanted me to talk about, and I'll bring it up in my slides, is something that I'm hoping to do over the coming weeks, is work with everyone in the community to build an all-weather ETF portfolio. I remember the big kind of thrust from last week's feedback was that we would love to have a session on, ETF overlap, ETFs for diversification, and ETFs for a core portfolio. I know a lot of you are interested in this. So we will be doing that over the next few weeks. And I'll be kind of breaking down some ETFs. So please send in some of the questions that you have. You can even stick them in the chat tonight, and I'll go back through it to design some of these episodes that I've got coming up, as well as taking all of your suggestions on board. So Joe said about Luke, enjoyed the discussion, but Luke included half a dozen acronyms in virtually 2 sentences. I know it gets quite complicated. When I asked him to answer those questions, Joe, he did run out of time. But one of the big things which you probably wanted to pick up on there at the end was, and I can paraphrase for Luke, which is basically that a lot of the businesses that are small or mid cap lithium companies or developing companies, these businesses are still going through that period of what we call execution risk. And this is where the miners have, flashy slide presentations and I guess talking about their projects and what they've found in the ground, but actually getting the product out of the ground and onto a boat or onto a ship is it what we call the execution risk, because you have to design the mine, you have to finance it, and you have to build it, and then you have to pull it out of the ground and start shipping. And that's the way we measure that is we call it an NPV model. So NPV effectively means like the net present value of a project. So we take in what it costs to do the project and what we expect the return to be, and we basically make a decision. If it's a positive number, it means that the NPV is positive, and it means that it's a project worth doing. And if it's negative, it's probably a project that was not something that is worth pursuing. So that's kind of the key thing, which you might have got lost in a bit of the jargon there, but it's I think Luke's summary was excellent. So Google quickly, Joe. So with that said, so in the next few weeks, we will be doing some ETF portfolio deep dives, and we'll be building a portfolio. But for the last 10 minutes of tonight's show, I just love to open the floor to you. Ask me your questions. I wanted to do an AMA, otherwise known as a Ask Me Anything, a few weeks ago, and I didn't get the chance to do it. So I want to just open the floor to you and get your questions, and I'll go from there. In the meantime, I would say that some of the things that I've been working on recently, and I know a lot of our members wrote into me at Rask, and they said this was really interesting, was something that I've been working on lately is this idea of, now that the market may be at a point, and this is me, fingers crossed, touching wood, thumb suck, finger to the wind type stuff. Now that the market may be getting to a period where we do see some stability, because maybe inflation isn't going to be as bad as people expect, that's fingers crossed. Maybe interest rates don't rise as quickly as people were expecting previously, fingers crossed. Maybe now we start to see some normality in investing returns. And what that means is that you have a choice right now as an individual investor. I think you have a choice to kind of set your strategy for the next 2 to 3 years on that basis, on the basis of what is normal in the stock market. So one of the things that I've been spending a lot of time on lately is trying to find great companies. And everyone says this, but I'm trying to find the super high quality companies. So Luke actually wrote an article for our website the other day, Rask Media, and he had a different opinion or a different take on the way I was measuring things. But as you know, on Selfwealth Live, we've covered return on invested capital, and we've covered how to assess the quality of a business with its moat, its competitive advantage, and all these things. And I've been running through these filters and lists of different companies. And what I'm hoping to find is that some of these amazing businesses can actually be purchased at, if they're not great prices, at least good prices. Because when the market's really shaky like this is when you get the opportunity to buy those companies that might be beaten down a little bit. So there's been some questions come through, and that's something that I've been working on. So I'm happy to talk to that. But I can see, Paul, you've said, what are your thoughts on debt recycling? I came across it the other day when reading. So, Paul, and for everyone's benefit, the idea of debt recycling, I'll give you a very simple example. When someone owns their home and they have a mortgage against their home, they pay their mortgage each and every month to Commonwealth Bank or whoever your home loan is with. You don't actually get the benefit of making that interest tax deductible. So what I mean by that is, if you pay your mortgage every month, you can't claim a tax deduction for just paying your mortgage. However, if you have an investment property, you should be able to claim the tax deduction for the interest component on that loan. So what people tend to do is they tend to use investment loans to buy things, whether it's a property, whether it's a diversified ETF or stock portfolio or something like that. And what people tend to do is they tend to pay down the debt and then redraw on it, and then they can finance an investment portfolio with a loan. Now, these are quite, if you think about what I'm about to talk about, using a loan to buy shares or something like that, on the one hand, they can be extremely risky if they're not used prudently. Now, on the other side, some people say that you can use these and you can use them effectively. So on the one hand, on the more extreme end, you've got things like margin loans. And in my opinion, using that type of debt to buy stocks is very, very, very risky. And I'll actually bring you up a slide that you may remember, Paul, from a few weeks ago. This is from Warren Buffett. And he's answered this question many times before. And he says, if you're smart, you don't need leverage. Just think of leverage as debt. And if you're smart, you shouldn't be using it. And this is his kind of like age-old quote. And even though it's a little bit, I guess, shallow in its remark, it's kind of true. A lot of people shouldn't be using debt to the recycling debt and using it to buy something else. But then there's one for. I'll give you one scenario. I got given a hypothetical scenario, Paul, not too long ago, and the hypothetical scenario was if you had $1 million, what would you do with it? Now, everyone is different. Everyone is completely different, right? But for me, what I would do is I'd pay off my mortgage instantly. Now, I'm not in a rush to pay off my mortgage, but if you just gave me $1 million, that's what I'd do with it. And then I'd probably use the equity in that home to take out another loan to go on and buy an investment. So that's effectively debt recycling because we're paying off debt and then we're recycling it. And the new loan should be tax deductible if I could structure it right. So in effect, you have no mortgage, but you have a loan against an investment portfolio, which you should be able to sell. And the bank that gives you a loan should have buffers in place. But that's, again, quite risky. And that's just for me. This is obviously general financial information only. So in some instances, long story short, Paul, I think it's okay. In many instances, I think it's not okay. And I think it's very risky. And that's probably the thing. Where did you hear about it, Paul? Where did you hear about debt recycling? Okay, so I got some questions. Owen, you've said the 15% US tax US takes out when calculating the W8 Ben form. Does that mean if your marginal tax rate is 32.5%, do you then only pay 17.5%? So the tax rules between residents and different countries, Owen, gets quite complex pretty quick. The ATO is a fantastic explainer on their website about this and some examples. And even though the W8 Ben form is for the US market, there are other tax rules that apply to different countries, and it all depends where you are as a tax resident. So all the W8 Ben form does is just, in my understanding, and your accountant could clear this up for you, is my understanding is it just reduces the withholding tax rate. So this is just the tax rate that applies between the countries being Australia and the US. And I think, if I'm not mistaken, that's set at 30%, and then it reduces that to 15%. But you'll still pay tax, and that's what the ATO wants to make sure you're doing. You're still paying tax on foreign income. So I would be saying, go and check out the ATO or speak to your accountant for that. Oh yeah, okay. Yeah, I remember, Paul, you said you remember that. Risky was my initial thoughts after reading. Yeah, risky, but not always. Not always. So, and you went on to say, and if they are in your SMSF, does that mean tax is considered as paid? I would highly doubt it, Owen, but you could go and check that out. I would go and check that out. So, yeah. Okay. Any other questions we have, guys? It's been a bit of an earlier night for us tonight. Please compare the usefulness of IRR and EBITDA as valuation metrics. Okay. So these are two quite different things, Paul. Pete. So IRR stands for internal rate of return, IRR. And basically it compares the return of an investment, but it doesn't consider the capital needs necessarily of a business. So basically, IRR is a method of calculating this. If I make an investment, right, and then that investment pays me a dividend for, say, each of the next 5 years, and then in the sixth year, I get my capital returned to me. Like, let's say I buy a stock and it pays me a dividend, and then after 5 or 6 years, I intend that it will be sold for $10 a share. Well, I would be calculating the cash outflow to buy the shares, and then the dividends coming in is a cash inflow. And then in year 6, I would get the shares back, which is another cash inflow. And what IRR does is it effectively just gives you a percentage, and it expresses a percentage, and it says, if for example, the percentage was 6%, it would mean that your indicative return is 6% per year. That's all it means. I use the IRR method when I am calculating some growth stocks. So what I mean by that is, sometimes you will know that I use the discounted cash flow analysis, which is where I take the cash flows of a business, I sum them up, and then I put them in today's dollars. That works extremely well for established businesses. It's not, it's a bit of art versus science in there, but the IRR method can be used as a common sense check to be like, well, if I buy the shares for $10 and then I sell them for $15 in 5 years, what's my percentage return? And that's how you can kind of compare the two models, and you can sense check your valuations. But IRR is very common overseas or in private equity as well. Jason, you said, would be keen to see some ETFs that cover lithium and hydrogen and uranium, the energy trifecta. Well, there are a few. Pardon me, Jason, there are a few. So there, some of the more recent ETFs, the Global X Uranium ETF, which is Atom. That's one. I think there was a Beta Shares one as well. I'm sure someone else could correct me on it. And then there was obviously the HGen ETF from those guys as well. Then there, well, obviously the ACDC ETF from there. I don't want to sound like I'm too much one-sided with Global X, even though they are a long-term sponsor of a podcast, but those are some of them. So there's the ACDC, which is the biggest play on lithium in the country. Yeah, ACDC says Pete. Rob in the chat. Okay. Pete, you've said the comparison of IRR and EBITDA was in relation to of mining projects. Yeah, okay. So the same rules apply, Pete. So basically, if you have a mining project, you can calculate the IRR using the costs that are expected to go into the project and the cash flows that will eventually come out. Now, EBITDA is just a way of expressing the cash flow of a business. So say, for example, you expected in year 6, the mine site would produce $100 million of revenue, and then there was $40 million of costs. Well, then you've got a $60 million EBITDA. And that's just a way to express the cost. It's like accounting version of cash flow or analyst version of cash flow. Now, the other method, which is what I was talking about before, is NPV. So there's NPV versus IRR. NPV is more commonly accepted in mining projects, I would say. They're both used, but NPV tells you the whole value of the project. The whole value of the project, including financing, is going to be positive, if that makes sense. Interesting take on lithium, says Steve, and how long it could go for. I think supply will catch up with demand over the next 2 to 5 years. So for me, it's a short-term opportunity. It's interesting, isn't it, Steve? I hadn't thought about that until Luke mentioned it tonight, and he referenced Tim Hoff. Copper, REE, nickel, and uranium could be ones to watch, especially with supply issues and ESG coming into play. I had never thought, Steve, about what he had said in terms of supply driving demand. It's not always the way it works. Normally it's demand driving supply, right? But if you think about that, if there's more supply coming online, eventually that will fluctuate the prices down. So eventually, as you know, even though things might go up over time, you might have big peaks and troughs on the way to more supply coming online. And what we're trying to find, just like iron ore in the super cycle of, in the lead up to the GFC, what we're trying to find is kind of that steady increase in prices over time. And you as a shareholder, you're going to have a heart attack on the way up and on the way down, because you're going to be experiencing the highs and lows of lithium prices. And as new projects come online, maybe there's increased supply, which pushes down prices. And then maybe there's more demand, as Luke was saying, which then increases prices. And then another mine comes online, and you just go like this the whole way. It's going to be quite interesting. So, Owen, you've said, using Navexa or ShareSite, what benchmark would you use to compare a balanced portfolio? Probably the best benchmark I would use, Owen, if I was comparing a balanced portfolio, and this is an interesting one. So a lot of people, when they think about using a portfolio tracking tool, they'll just use the default option, whatever's in there. And a lot of people, when they look at their superannuation fund, like say they compare Australian super balanced versus rest super balanced, they'll just compare the two balanced options, not actually knowing what goes on inside them. So for me, in my personal opinion, this is my personal opinion, a balanced portfolio is around about 60-40. So that's around about 60% investments in stocks and more aggressive type stuff, and 40% in bonds and cash and those types of things. And then you can break it up into 4 pieces if you want. But if you just think about that, you would want to be comparing against a portfolio, like a benchmark, that has 60% in risky assets and 40% in defensive assets. And so that's the way I would answer that question. But let's say, for example, you wanted just to see, well, how good am I as an investor versus Vanguard? Because Vanguard has a few different funds. I would be comparing my portfolio against this, which is the balanced ETF. So this is the ETF, Owen, you will know this, that has inside of it other funds. And inside of this portfolio, it's 50-50. So there's 50% invested in risky assets and 50% in like bonds and cash and that sort of stuff. And so this is the perfect kind of balance because you've got 50-50, right? So that's what I would be comparing to, as like I would be studying the long-term performance of this ETF against my portfolio. And you can see recently it hasn't done that well. So Harry says, what are your perspectives? And I'll answer maybe one or two more questions, guys, so get them in. Harry says, what are your perspectives on adjusting exposure to certain defensive assets, like gold included, after your conversation what you had with Luke? So, Harry, one of the things that I said last week, I think it was, actually, I think I've got this in the slides. I'll just bring this up. I think I said this last week, is that if we enter a period where we kind of rally out, or we start to see that maybe interest rates aren't going to go as high as we thought, well, maybe we rally out of this period of inflation. I probably don't want exposure to gold, at least not as much. Yeah, Steve, great to have you with us tonight. So thanks for joining us on Selfwealth Live. And so I'm now actively considering of moving our portfolios, our model portfolios, out of gold and into more traditional asset classes like shares, global shares, etc., and bonds for that matter as well. So in terms of perspectives on adjusting, absolutely. Like I think we at Rask, this side, we had gold in our portfolios, our core portfolios. And you could say maybe it was a mistake, but it probably wasn't a mistake. It was probably just what happened over the last couple of years. And you saw that dispersion that Luke talked about. So I think it hasn't really changed for me. I still believe that businesses are the number one source of wealth creation and innovation in our world. And so I'll continue to invest in them as a matter of course. The ETF benchmarks are a good call. Cheers, says Owen. No worries, Owen. You're welcome. And great question, Harry, by the way. Great question. So over the next few weeks, hoping that we will be able to bring to you a series that helps you build a core portfolio from the ground up. So this is what I do for our members each and every day. And I think using ETFs to build an all-weather, that's kind of the catchphrase, all-weather core portfolio is probably the way to go now. There are risks to ETFs, but I think that's kind of the key thing, is that ETFs are low cost, diversified, and they're easy to use. So that as a default, you should be exploring them, at least as an option, alongside other things like managed funds, direct stocks, etc., listed investment companies, etc. So we'll be covering all these in the next few weeks. If you do have any questions, you can send them to me on social media. And finally, I've got my quote for this evening, which is more investors don't copy our model, it's supposed to say, because our model is too simple. Most people believe you can't be an expert if it's too simple. This comes from Charlie Munger, the 99-year-old investing sidekick of Warren Buffett, who basically said that so much of what they've done, being Charlie Munger and Warren Buffett at Berkshire Hathaway, and all of the incredible financial success that they've had, is not through being smarter. It's not through anything else like that. It's actually just through having this really simple way of investing and doing it repeatedly for an incredibly long period of time. And I couldn't agree more that investors go through this period of like where they overcomplicate things, and they realize that for all the overcomplication, things don't get any better, at least in my experience. And eventually they just come back to keeping it simple. And what Charlie here says that it's because it is so simple that the professionals don't recommend that to you. Paul, like you say, the KISS principle. I'm really excited for this ETF series, really excited, says Owen. That's great. Okay, and do you consider gold products defensive or volatile? Personally, they are in my volatile pile. I can answer this one on the way out the door, Owen. So I consider gold companies and gold ETFs that invest in the companies. So not like there are two different types of gold ETFs in Australia. There's the gold ETFs like the Van Eck one that Luke brought up that invest in the shares of gold companies. And then there's the ETFs that just invest in pure gold. We've always used the pure gold ETFs rather than the gold companies ETFs, because when we invest in gold, we only use it to reduce the risk, to minimize the volatility. We don't invest in gold for growth, and we don't invest in gold for income because it doesn't produce any. So we are literally just including it in that defensive side of the portfolio, or what I like to call the alternative defensive side of the portfolio. So it's defensive, but it's an alternative type of investment. So that's it. All right, guys, on behalf of Rob from Selfwealth and myself, Owen Rask, thank you for joining us tonight. And thank you for sending in some questions there in the last 15 minutes. I didn't get to this a few weeks ago, so I really do appreciate it. We'll be back in the next few weeks and hopefully really just put on a masterclass of how to build a core portfolio. I'll show you exactly how I do it out of ETFs in the core. So, yeah. What's Rob said? Rob said, please subscribe. I know a few of you haven't. Look at that. That's like the teacher cracking the whip. But thank you, everyone, for coming along tonight. Thank you for joining us, as always. Keep this machine running, says Rob. Martin says 9.04K. That's a lot. That is a lot. So thank you, everyone. Thanks, Bree. Thanks, Caroline. Thanks, Martin. Everyone, Jason, for joining.